Hey everyone, and welcome back to Safe Simple Sound, the podcast that helps you build a strong financial future with clear, actionable advice. Today, we are talking to a very specific group of people: the dreamers, the builders, the ones who just took that huge leap of faith, the new business owner. First off, congratulations. That first month is an absolute whirlwind of excitement, and let's be honest, probably a little bit of overwhelm. You're trying to do everything at once, and it's easy to let the financial stuff slide. By the end of this episode, you'll have a clear, actionable small business tax checklist to guide your new business tax setup. You'll feel more confident, more in control, and ready to focus on what you do best: running your business. Please note that this content is for educational purposes only and should not be considered personalized financial advice. Always consult with a qualified financial professional before making financial decisions. All right, let's get into it. Let's be honest, a little intimidating. Parts of the entrepreneurial journey are the first 30 days. We're building a foundational checklist to get your new business tax setup done right so you can focus on what you actually love to do. So you've got the brilliant idea, the passion is there, maybe you've even made your first sale. But how do you make it official? How do you go from a side hustle to a legitimate business in the eyes of the government? That's what we're kicking off with today. Our first topic is making it official, getting your EIN and why it matters. Let's start with the basics. What on earth is an EIN? Think of an employer identification number, or EIN, as a social security number for your business. It's a unique 9-digit number the IRS gives you, and it's the cornerstone of your business's financial identity. It's what you'll use to pay federal taxes, hire employees, and open a business bank account. It's a critical first step. So the big question is, do you need one? This is where a lot of new owners get stuck. The rules are actually pretty clear. If you're setting up as a corporation or a partnership, the answer is a definite yes. If you plan to hire even one employee, including yourself if you're an S Corp, you absolutely need an EIN. It's non-negotiable. But what if you're a sole proprietor? You're a freelancer, a consultant, just a one-person show. This is where it gets interesting. Legally, you might not have to get one. You could just use your personal social security number. But I'm going to tell you why you should probably get an EIN anyway. First, many banks require one to open a business bank account. Second, it helps you establish business credit. And third, it just looks more professional when you're filling out forms for clients. It separates you from your business. And that brings me to something that isn't on any official form: the psychological impact. Have you ever felt that little bit of imposter syndrome? That feeling of, am I really a business owner? Getting your EIN is like getting a birth certificate for your company. It's the moment the government officially recognizes your venture. It's a small step that makes it feel incredibly real. Okay, so you're convinced? You need one. Now, how to get an EIN? This is the best part. It's fast, easy, and completely free. I want you to burn this into your memory. The only place you should go is the official IRS website, irs.gov. You can apply online and get your number immediately. And this is where I need to give you a heads up about a common trap. If you Google "get an EIN," you're going to see a bunch of third-party websites pop up offering to get the number for you for a fee. Don't fall for it. These are basically services that charge you $50, $100, or even more to fill out the exact same free form on the IRS website that you can do yourself in 15 minutes. It's one of the most common scams new business owners encounter. Getting your employer identification number is a free service provided by the IRS for new business owners. You don't need a middleman. Finally, let's talk about timing. When should you do this? The answer is simple: as soon as you decide you need one. You want to have that number in hand before you need it to open that bank account, hire that first team member, or file your first tax return. Don't wait until you're on a deadline and scrambling. Procrastination here just adds unnecessary stress, and our goal is to improve tax compliance for your small business without the headache. It's about being proactive, not reactive. So to wrap this up, the EIN is your business's official government ID. It legitimizes your venture, and it's essential for things like hiring and banking. Remember the 3 most important takeaways. Know if you need one, and even if you don't, consider getting one. Apply for it yourself for free directly at irs.gov and do it early to avoid any last-minute stress. This brings us to your action item. Your mission for today is simple but powerful. I want you to go to irs.gov/EIN. Even if you just bookmark the page for later, go look at it. And if you meet the criteria we just discussed, I want you to take the next step and fill out the application. Seriously, it takes less than 15 minutes to solidify your business's identity and check this massive item off your list. Once you have that official number in hand, you've unlocked the next crucial step in building your financial foundation. But giving your business an identity is just step one. Step two is giving it a home. And that brings us to what I believe is the single most important, non-negotiable financial step every new business owner must take: drawing the line, the critical importance of a separate business bank account. Now, let's talk about the most common, and honestly, most costly, mistake new entrepreneurs make. It's called commingling funds. It's a fancy term for a very simple act: mixing your personal and business money in the same bank account. Your client payment goes in, and your groceries come out. You buy new inventory with the same debit card you use for your Netflix subscription. I want you to picture this. Imagine throwing all of your laundry, your gym clothes, your work shirts, your socks, your dinner napkins, into one giant unsorted pile. Now imagine tax time is tomorrow, and you have to pull out only the business-related clothes and prove they were for business. It's a total nightmare, right? That's what commingling does to your finances. It creates a bookkeeping disaster, and worse, it's a massive red flag if you ever face an IRS audit. They see that mess, and it immediately calls the legitimacy of your business into question. So how do we fix this? Simple. A separate business bank account is your best friend. It's your ultimate tool for clean record keeping. Think of it as a dedicated, pristine filing cabinet. Every single transaction that goes in or out of that account is related to your business. There's no confusion. It creates a clear, undeniable trail of your income and your deductible expenses. When tax time rolls around, you don't have to spend hours scrolling through personal statements, trying to remember if that $50 Amazon purchase was for printer ink or a birthday gift. The clarity it provides is priceless. Now, a question I get all the time is, Alex, this sounds great, but I've already been in business for a few months and I've been mixing everything. What do I do? First, don't panic. You can fix this. The best way to untangle that history is to draw a line in the sand today. Open that new account now and start fresh with all future transactions. For the past months, you'll have to do a bit of homework. Print out your old statements, grab 2 different colored highlighters, and go through every single line item. One color for business, one for personal. It's tedious, but it's the only way to clean up the past and get your books in order. Okay, so you have the account. How do you use it correctly? It comes down to 3 simple rules. Rule number 1, all business income goes in. Every check from a client, every payment from a customer, every single dollar your business earns gets deposited directly into this account. No exceptions. Rule number 2, all business expenses go out. Need to pay for web hosting, software, a contractor? Use your business debit card or write a check from the business account. This keeps that clean trail we talked about. And rule number 3, the most important one, pay yourself properly. You don't just take cash out of the drawer, you create another clean transaction. You write a check from the business account to your personal account, or you do an electronic transfer. In your bookkeeping software, you label this an owner's draw. This shows exactly how much profit you are taking out of the business to live on. Following these rules does more than just ensure tax compliance for your small business. It's about professionalism. When you treat your business finances separately, you start to see your venture for what it is: a legitimate, standalone entity. It allows you to accurately see if you're profitable. It helps you build a financial history that will be critical if you ever want to apply for a business loan or grant. It's the foundation for a scalable, successful small business. So you're ready to open an account. What should you look for? When you're choosing a bank, focus on a few key features. Look for accounts with low or no monthly maintenance fees. Many will waive the fee if you keep a small minimum balance. Make sure they have great mobile banking, especially mobile check deposit, which is a lifesaver. And most importantly, check if the bank integrates directly with accounting software like QuickBooks, Xero, or Wave. This will save you countless hours of manual data entry. So, let's quickly recap. First, mixing funds is a bookkeeping nightmare and an audit red flag. Second, a separate business bank account creates a perfect record of your income and expenses. Third, use it correctly. All business money in, all business money out, and pay yourself with a clean transfer. And finally, this is a powerful step towards building a professional, scalable business. Which brings us to your call to action for this week. It's time to stop thinking and start doing. This week, your mission is to research 2 or 3 banks that offer small business checking accounts. Compare their features and fees, and take the first step to open your account and draw that critical line between your personal and business finances. But once you have that account, you need to decide on the rules of the game. How are you going to keep score? What does your financial year even look like? That's what we're diving into today. Setting the rules, your first big financial decisions, tax year and accounting method. Now, don't let those terms scare you. This is a crucial part of your new business tax setup. But for most of you listening, it's going to be surprisingly straightforward. Think of it like setting up the basic operating system for your business's finances. You do it once, you do it right, and it makes everything else run smoothly. First up, let's talk about the schedule your business runs on. This is called your tax year. Every business has to report its finances on an annual schedule, and you have 2 main choices. The first, and by far the most common, is the calendar year. This is exactly what it sounds like. January 1st to December 31st. It's the calendar hanging on your wall. If you're a sole proprietor or a new partner in a partnership, the IRS generally requires you to use the calendar year, since that's how you already file your personal taxes. So for the vast majority of new entrepreneurs, this decision is already made for you. Easy, right? One thing checked off the list. The other option is a fiscal year, which is any 12-month period that ends on the last day of any month, except December. For example, a retail business might want its year to run from July 1st to June 30th to better align with its busy seasons. But honestly, unless you have a very specific, compelling reason to do otherwise, and you've discussed it with a professional, stick with the calendar year. It keeps your business and personal tax schedules perfectly aligned. Okay, so we've set the calendar. Now let's talk about how we track the money moving within that calendar. This brings us to our second big decision, choosing an accounting method. And this is where you really need to pay attention. The first and simplest method is the cash method. I want you to think about this like your personal wallet or checking account. It's incredibly intuitive. With the cash method, you record income when the money actually hits your bank account. You record an expense when the money actually leaves your bank account. That's it. Let's say you're a freelance writer. You finish a project on December 15th, send the invoice, but your client doesn't pay you until January 10th. With the cash method, even though you did the work in the old year, that income belongs to the new year, because that's when the cash arrived. It's simple, it's clear, and it's the go-to method for most new service-based businesses. Now, let's contrast that with its counterpart, the accrual method. The accrual method is a little more complex, but it often gives a more accurate picture of a business's health. With accrual, you record income when you earn it, regardless of when you get paid. And you record expenses when you incur them, regardless of when you actually pay the bill. So, let's go back to that freelance writer. Under the accrual method, you'd record that income in December when you earned it by completing the project, even though the money isn't in your hand yet. Okay, Alex, you might be thinking, that sounds more complicated. Why would anyone do that? Well, here's the key. You generally must use the accrual method if your business sells products and manages inventory. Imagine you own a small online boutique. You buy a batch of sweaters in October. You sell them all in November on credit, meaning customers will pay you in December. Under the accrual method, you match the revenue from the sweater sales in November with the cost of those sweaters in November. This gives you a true picture of your profitability for that month. If you use the cash method, Your books would look like you had a huge expense in October and a huge windfall of income in December, which doesn't really tell the story of how your business performed in November. This brings up a really important question for you to reflect on. When considering cash versus accrual accounting, how might your choice impact your perception of your business's monthly financial health and cash flow? The cash method shows you exactly how much money you have, while the accrual method shows you how profitable you are. They're two different but equally important stories. Now, here's the most important takeaway for this whole segment. Choosing your tax year and your accounting method aren't just casual decisions you make on a whim. These are foundational choices you officially adopt when you file your very first business tax return. And you can't just change your mind next year because you feel like it. Once you've filed using one method, switching to another requires getting formal permission from the IRS. It involves paperwork and can be a real headache. This is a classic measure twice, cut once situation. Getting it right from the start is a cornerstone of good tax compliance for small business. And if you're listening to this and feeling unsure, maybe you do a mix of services and products, or your business model is a bit unique, that's a perfect sign that it's time to seek professional advice. So let's recap. 1. Your tax year is your financial calendar. For most new sole proprietors, it's going to be the standard January to December calendar year. 2. The cash method is simple. You track money when it actually moves. Perfect for most service businesses. 3. The accrual method tracks money when it's earned or owed, which is essential for businesses with inventory. And 4. These are official decisions you lock in with your first tax return, so choose wisely. And that brings us to your call to action for today. It's simple, and it won't take long. I want you to take 5 minutes today and answer a simple question. Is your business primarily service-based, or do you sell physical products? Just think it through. Your answer is the first and most important step in choosing the right accounting method for your new business. Once you have that answer, you're one giant step closer to building that rock-solid financial system we're always talking about. And that brings us to the end of our guide. Let's quickly recap what we covered. We walked through the 3 foundational pillars for your new venture. Getting that official EIN to solidify your business identity, drawing a hard line with a separate business bank account to keep your finances clean, and setting the rules by choosing your tax year and accounting method, like cash versus accrual. My goal today was to take some of the chaos out of that first month and give you a clear, actionable small business tax checklist. This isn't just about following rules. It's about building a smart new business tax setup from day one that will save you from massive headaches later. Think of this as the most important part of your overall starting a business checklist, the part that protects your bottom line. If you take only one thing away from our discussion, let it be the importance of that separate bank account. It's the simplest, most powerful step you can take towards professionalism and peace of mind. Understanding these basic business tax requirements is what gives you the freedom and confidence to focus on the exciting stuff. Thank you so much for spending your valuable time with me today. I truly appreciate you tuning in and being a part of the Safe, Simple Sound community. All the resources we talked about, including a direct link to the irs.gov/EIN page, are in the show notes. If you found this episode helpful, the best way you can support the show is by leaving a quick review or sharing it with another new entrepreneur who might be feeling a bit overwhelmed. And of course, hit that subscribe button so you don't miss what's next.